Hello, I'm Kyle Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're focusing on investment trusts and specifically the potential investment trust discount opportunities. Joining me to discuss this topic is Peter Hewitt, who specialises in buying investment trusts. Peter manages the CT Global Managed Portfolio Trust. So Peter, for investors looking for a potential bargain, there has for around 18 months been no shortage of potential investment trust discount opportunities. Which sectors are you finding the opportunities in terms of there being very large discounts?
Well, Kyle, it's interesting. Yes, 3 years ago, the average sector discount was 2. By last autumn, November time, it got to 19. So that's very significant underperformance from investment trusts due to principally interest rates rising and high inflation and fear of recession. Now this year we've moved on a bit and the average sector discount currently is round about 14, and so it's begun to narrow a little. But the big thing is it's stabilised, it's not continuing to go out. I do think there's really quite a series of opportunities in the sector. And a lot of things are falling into place. So, for example, the UK isn't in recession, and if anything, growth might pick up a bit towards the end of the year. Politically, we all know what's happened, and let's just say things are now pretty much resolved for the next couple of years anyway. And so that sets the scene for a better investment environment. And within the Managed Portfolio Trust, which is itself an investment trust which invests in other investment trusts, I have 3 key themes which I'm putting into place both in my growth portfolio and indeed also the income portfolio. And the first one, which I have to say is now coming through in the last couple of months, is UK equity trusts. Investment companies specialising in UK equities, and particularly ones with a bias towards or a specialisation in medium-sized and smaller UK companies. I think they're looking very interesting. Discounts are still quite wide, 8, 10, 12%, not uncommon, and so it's come in from the very widest, but they could go a lot further. But importantly, it's the asset value, I think, that could push on quite sharply over the next 6 months or a year. And the key reason for considering UK trusts is the past 3 years, they've probably been a big avoid, to be honest, because although the FTSE index has performed reasonably, it's all been due to the biggest 10 or 20 companies, oils, banks, pharmaceuticals, and the likes. And in that environment, active fund managers almost always underperform. They will tend to try and find better growth companies or ones with more value, and that will tend to be in the medium-sized or smaller end of the market. And now what's been happening the last few months is that segment of the market is starting to lead UK equities, and with it, performance has picked up markedly. So I like that area. The second area I'm keen on are private equity trusts, where you have discounts of in excess of 30% in a number of cases. And again, they went as wide as this a couple of years ago when there was a fear of recession. Now, recession hasn't actually happened. Asset values for most of these trusts have either gone sideways or are now starting to appreciate, which is good, and they're still on extremely wide discounts. And the long-term records of some of these private equity trusts really are mouth-wateringly good. So it's an area I think you can find some bargains. And then the final area, and I call these secular growth trusts, and that is investment companies that have a high weighting in the technology sector, healthcare, biotechnology. And although it can be volatile, they can come down quite sharply. Over the long run, that's where you really make a lot of money, and you can make many times your original investment. And there's a whole series of trusts that I favour that actually are on still quite attractive discounts, 7, 8, 10% or more. So these are the three key themes I'm putting into place in the portfolios.
And in regards to the UK theme that you're playing, you mentioned that you're keen on exposure to UK medium-sized companies. I saw that you recently bought a new position in JPMorgan UK Small Cap Growth and Income. Could you talk us through why you picked that particular trust, and could you give us a flavour of your other UK exposure?
Yes, indeed. Well, I bought this one earlier this year, shortly after it actually completed quite a major transaction where JPMorgan UK Small Companies merged with JPMorgan UK Mid-Cap Trust to make around about a £500 million trust. So quite big, quite liquid, and costs really quite attractive. I like it because the manager, Georgina Britton, and there's a team behind it, but Georgina leads it, very experienced. And over the long run, and I mean 20 years or more, she's built a super record. Yes, it can also be a bit volatile, but over the long run, you've made quite a lot of money. And given that the underlying companies they invest in are really inexpensive, and I think the PE of the portfolio is probably somewhere around about 11 times earnings, not expensive at all. You're getting some super growth companies there at a discount. You've got a manager with an excellent record, and it's unusual, but I've bought this trust both in my growth portfolio and in my income portfolio. There's only 2 or 3 that are in both portfolios, and that's because it's got a 4% dividend yield, part of which comes from capital, but most of which actually comes from the underlying dividends from the holdings. And I think this one has got a tremendous prospect. And actually, in the last couple of months, it's begun to perform quite well.
And in regards to your other UK exposure, could you name a couple of other investment trusts that you own?
Yes, indeed. In the income portfolio, I've got Mercantile, which is another JPMorgan trust. It specialises in mid-cap companies, and same argument applies. It's got a strong manager, Guy Henderson. It's a big trust. It's over 2 billion. It's on a discount of 10 or 11%. I think that's one to watch. It could do well. In the growth portfolio, I've got Henderson Smaller Companies, which I like a lot, and also, and now it's become a top 10 holding actually through performance, is Aberforth Smaller Companies. Now that's a value-orientated trust, and the PE on the underlying portfolio is about 8 times earnings. So I honestly don't know if it'll beat the all-share index or its own benchmark. But from that level, unless we are going to have a nasty recession, you are going to make quite a bit of money. And it's also on a discount now of somewhere between 8 and 10%.
Another investment trust I saw you increased exposure to lately is TR Property. Is this a classic case of it being an unloved asset class? It's been out of form as well, and the discount is potentially attractive?
Yes, in a word, you're absolutely right. And as with mid and small cap investment trusts, property trusts, they need interest rates to move lower. And although they haven't as yet in the UK, I think they will do at some point in the second half of this year. And that immediately sets a better environment for the asset class. TR Properties is run by Marcus Fair-Mudge, who is an outstanding manager. He knows the sector backwards. It invests in mainly listed property companies in the UK and Europe. And some of the discounts there are very wide indeed. But what Marcus will tell you is what's marked the last 2 or 3 years, which have not been good for property at all, out from previous downturns, is there's not been a speculative element. There's been no overbuilding. So it's not like you've got to work through a huge pool of assets that are unoccupied. And I think that sets a better theme for it. I think you'll see rental growth coming through, certainly in certain office locations. I think in industrial and logistics properties, even in some shopping centres as well. So he's all over that. And I think the income element of TR Properties is not to be underestimated. It's got a fantastic dividend record. I think it compounds something like 8% per annum over the last decade. And it's got a decent yield of more than 4%. So one I definitely want to own.
And when you're assessing an out-of-form sector or asset class, which UK smaller companies and property would fit into, how do you decide whether to take the plunge? Are you looking for a potential catalyst for change?
Yes, the answer is definitely yes, because it's all very well buying something that appears good value, but it can stay good value for years and years and years. And certainly you have to have patience. But if there's a catalyst, it would probably be interest rates moving lower. I think the first part, the UK not going into recession, same with Europe to some extent. Both the UK and Europe have had modest recessions at the beginning of this year, but are moving out of it. Not strongly, but you don't need any more than that. But it's the cost of money. And if you're looking at a catalyst, it'd be that, along with the discounts on the various vehicles that you're choosing to consider investing in. And that can give you quite a cushion, a safety cushion to invest in. But it does mean that when things turn, you'll get some pretty outsized returns. And my feeling is actually, I feel a bit like a kid in a candy shop. There's some fantastic bargains with the overall environment gradually improving.
And when it comes to investing, it's easier to buy than it is to sell. I think that's what many investors would agree with. So what do you do in a scenario when you're invested in an investment trust, it's not been performing well? How do you decide whether to keep hold of it, double down by buying more, or cutting your losses?
Not easy. And Kyle, you've asked the hardest question of all. And most fund managers are probably not great at selling stocks. But I try, if for example, you've had a change of manager or a significant change of circumstances for a trust, that may be a cause to sell. It may have moved to a premium, or it may have had a period of just very, very strong performance. And you may not want to sell all of it, but you might want to lock in some profits. And occasionally you just question what the manager's been doing and have they perhaps lost their way a bit. And that happens to a lot of trusts over time. So it's a combination of all of these, and then you reach, and also if you run an investment trust, it's a fixed pool of capital. So if I've got, a number of interesting ideas on the subs bench that I want to bring on, I have to realise profits from somewhere.
This then leads me to ask about Edinburgh Worldwide, the Baillie Gifford managed investment trust. I know it's a trust that you recently sold. It's been out of form for a number of years now. It invests in global smaller company shares. Could you talk us through why you decided to sell rather than hang on in the hope of a recovery taking place?
This is an interesting case in point. Yes, I sold Edinburgh Worldwide earlier this year. I saw the manager in January, actually. It invests globally in small cap companies. It's got quite a lot in America, some in the UK, a big weighting towards technology and healthcare, some biotechnology as well. But it had genuinely underperformed really quite substantially. It was in all the wrong areas that have performed badly in the last 3 years. But I sold it because I just felt that the manager, who I think Baillie Gifford are good managers, and they do find some interesting companies, but I felt it had far too long a list. There's a lot of companies at the bottom end of the list. I think there's 60 smallest holdings, accounted for barely 10% of the portfolio. And it just kind of felt there was not enough decisions being taken there. It has some interesting companies, and it's a sort of investment trust that I'll actually immediately put on the potential list, and it wouldn't surprise me if I owned it again at some point. But allied to the fact that it underperformed, it was at a bit of a discount, and remember this was January, February, I also was forming the view that, funnily enough, a couple of other Baillie Gifford trusts, Scottish Mortgage and Monks, which invest in technology and healthcare also, but typically bigger companies, I just felt they had more upside to them. Not in the short term, in the longer term. They also were selling at wide discounts. So I had to find some proceeds from somewhere to, if I wanted to increase the holding in these trusts, and it was Edinburgh Worldwide. But I could easily envisage myself owning Edinburgh Worldwide again at some point in the future.
So you've owned Scottish Mortgage and Monks for a number of years, is that correct? And have you been increasing exposure to both?
Yes, is the answer. A couple of times, certainly in the autumn of last year and again earlier on this year in the springtime. And I think Scottish Mortgage definitely has passed the bottom. It peaked at sort of £15 a share in the fourth quarter of 2021. I sold half or more of my holding in January 2022 at round about £13 and thinking I'd got a very bad price. But by the summer of that year, they were at £6. Now, actually, you could argue I should have sold them all. But I do know what they invest in is some really exciting companies for the long term. So I held a smaller position and it based the share price between £6 and £7 over the next 12, 18 months. But I attended a seminar that the managers ran in January and you could just tell that they were on the front foot. The outlook for some of their big holdings, both unlisted, and they've got holdings like SpaceX, Northvolt and ByteDance, all huge companies, any of which could list in the next year or two, as well as some of their big listed holdings like Nvidia and ASML and both semiconductor companies. They were really beginning to perform. And it was still at a wide discount. So that's why some of the proceeds from Edinburgh Worldwide found its way into Scottish Mortgage.
And Monks is considered by some like a less aggressive version of Scottish Mortgage. It's more diversified. I think it owns around 100 companies. Could you explain why you own both? Are they both sufficiently different to be in your portfolio?
Yes, they are quite. I mean, there are a few companies that are similar, but typically whereas Scottish Mortgage might have a 5, 6, 7% weighting in, say, Nvidia, Monks probably has a 1 or 2% holding, but it's got quite a number of holdings. It's more geographically diverse. It's exposed to growth companies. It hardly has any unlisted companies. It's got one holding, Baillie Gifford's own private equity trust, the Schiehallion Trust, whereas Scottish Mortgage has got somewhere between 25 and 30% in direct unlisted holdings. So it's probably a slightly less risky but wider spread portfolio, and I like them both. Monks has got a lot of holdings Scottish Mortgage doesn't have, but it also has been selling at a double-digit discount, and I think offers some very attractive prospects.
And I also wanted to ask you, are there any particular types of investment trusts or investment trust sectors that you would just completely steer clear from, even if you saw very high discounts?
Well, you have to keep your mind open as much as you can and not let sort of investment prejudice, which can easily happen, kind of colour your judgment. I tend to avoid single country funds simply because I'm not expert in the individual countries. And now, I don't mean America or Japan, I do mean smaller, probably emerging market type trusts. Some in the alternative sector are not for me. I've got one debt trust, I don't really like them, but some of them can give you quite good income. And I think also in the case of property, and you mentioned TR Property earlier, I kind of have more or less come out of most of my direct property holdings and kind of outsourced my exposure to TR Property, where I've got quite significant holdings. And I've found property, you've really got to spend a great deal of time to understand each trust individually, its debt structure, where it's invested, the rental growth outlook. So I think it's best done through TR Property.
And finally, while there are plenty of potential investment trust discount opportunities at the moment, and it is one of the advantages of the investment trust sector, is the ability to pick up an investment trust for less than the sum of its parts. The ultimate driver over the long term is the performance of the portfolio, the net asset value, the NAV. Is that fair to say, Peter?
Definitely. I mean, I think discounts, we all like to pick up a trust at a wide discount. And whereas it's important to try and do that, it is not the dominating factor in long-term performance, because over time it's how does the asset value perform, and there's no question about that. But just harking back to, say, UK trusts, Kyle, and those with a mid and small cap exposure, I actually think the outlook is really quite good for the asset values going up. in the next 12 to 24 months, I'd like to see quite decent performance from that area. The underlying companies they're investing in are cheap, and I think profits and earnings growth will pick up. But if I can do that, and then you see a trust maybe on a 10 discount, that's maybe itself got 5, 6, 10% gearing, then you could get quite a turbocharged return for a while. And I think we're in that stage now. And if I was leaving you with one thought is, actually, now is the time to be seriously considering, investment companies and investment companies with those characteristics, because I think they're really very interestingly poised.
Well, thanks to Peter, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, it'd be great if you could leave a review or give us a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, ii.co.uk. And I'll see you next week.